watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Schalk Louw from PSG Old Oak and Alex Duys from Umthombo Wealth. Be sure to send questions. Email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. Gents, appreciate the time. Schalk, let's start with you. You do your sort of monthly wrap-up on the Twitters or the X's, I'm not sure what we call it these days. The one that really stood out for me locally, another good May, and in fact we've had a fairly spectacular 12-month run on the JSE.
Yeah, good afternoon, Simon, and good afternoon to all the listeners and watchers. Yeah, what a month, what another month, what a year, and what a, let's call it 12 months we've had. I mean, you just mentioned it. I mean, Simon, you know I've had this conversation many times. The local is lekker, and people were sort of hesitant, and you were sitting 12 months later. If I told you 12 months ago, we're going to see a further 27% growth in the local stock market. We're going to see 22% in the local bonds. That's a total return, and local listed SA property, 33% or 32.5%. I mean, you would have told me, where do I sign? And yeah, it's been a phenomenal ride. It's been interesting. It's today it feels like the morning after the night before. We've got a whole new environment. Hopefully, it wasn't that good old saying, "Sell in May and go away."
Yeah.
But it does seem like markets are getting a little bit more upbeat on South African assets. We've been really resilient. I mean, when you look at our performances, and people will say, well, it's maybe just a flash in a pan. Well, if you look at our performances over the past 5 years, in dollar terms, we've pretty much outperformed. And this is now, remember, this has been from the lows that really the whole worst case scenario, COVID 5 years ago. And if you take that let's call it those times 5 years ago, MSCI All Country World yielded a return of just shy of 14% per annum. MSCI Emerging Market Index just over 7% per annum. And good old South Africa, over 17% per annum in dollar terms. So, yeah, what a ride it's been, and let's hope it may it continue.
Alex, I mean, the question then perhaps, are we starting to get expensive, or is there still, and certainly when I look at the market, some of the results coming out, my sense is there's still a good level of opportunity. And of course, a lot of this was gold, a lot of it was REITs, gold under the gold price, REITs off a low base. Are you sort of starting to scratch your head about local valuations?
Yeah, I think the local valuations are still quite compelling. All we need is some growth. Right, so
yeah,
we have seen a bit of a reversal over the last few months about the June new trade, specifically some of the purely SA-linked stocks like the banks, for example, retailers, and so forth. But if there's any form of growth, then yes, valuation is very compelling. Banks, for example, still yielding anything between 7 and 10%. It's very likely they're going to grow earnings and call it mid-single digits, so that's quite compelling. Life insurance business like Sanlam, anything far from expensive, high-quality business. Many of specifically the industrial businesses, there are many of them that generate very high cash earnings, clean balance sheets, good, decent growth prospects. So I would probably concur there with Schalk that, even though we've had a good run, actually due to, call it gold stocks and so forth, there's more to come. But perhaps a little bit delayed what we initially expected. Beginning of the year, people were looking for closer to 2% economic growth in South Africa. Probably going to get 1.2 now this year, and then hopefully better the year after. Time will tell, but if that's the case, then there's certainly more upside and growth prospects in our view.
Yeah, I like your point. Imagine if the last 5 years we'd had, 2% a year economic growth, we could be doing a whole lot better. Let's go to some particular stocks. Quick couple of questions coming through this. I'm asking most folks. Alex, today is Valterra, the old Anglo Platinum, now demerged from Anglo American. Would you be keeping Valterra if you had held Anglo on Friday and you've now received the shares, or would you be looking to be rid of them and hang on to the sort of copper, iron ore parts of Anglo American instead?
I think there's a few aspects to it. So obviously, on a short term, I think the viewers need to be cognizant that a lot of investors that's going to receive Valterra shares probably are going to sell it.
Yeah.
And of course, Anglo American still got a 19.9% stake that they will sell at some stage in the future. So that means it's very likely that Amplats is going to underperform the other PGM stocks in the short term. Longer term, of course, they still got very high quality assets. So you would think if there is a technical sell-off, that could create opportunity to switch into that business. But that also depends on your view on PGMs. So if you're, example, very bullish on PGMs, Amplats will not be that geared. Something like Impala, for example, will be more geared to the upside, meaning the margins will expand quicker because of it's more got high operational leverage. But again, Valterra will give you more downside support if you think that we are going to remain in a tough environment. So it's difficult. So to answer the question, I won't necessarily be a forced seller. I probably think there's better opportunities than Valterra, but if you're a long-term holder, you might as well keep it.
Schalk, your view on it? The stock is down to Alex point some 3% today. Would you be running for the exits, or do you hang on to Valterra?
Yeah, Simon, it's an interesting one. I mean, this how does the saying go? Buy on rumors, sell on fact. I mean, we're sitting with the facts. I mean, it's been out that Valterra or the old Amplats will be stripped out of Anglo. So this is no new news. I mean, to Alex's point, I agree there might be a bit of an overhang now, but everybody knew it. I sat on at least two portcos where we discuss just that. Do we go and enter Amplats at this stage, or do we wait? No, we rather wait because we're worried about the overhang. So as we sit here, with Friday's close, I mean, Sibanye has a different story. Sibanye had a wonderful recovery this year, 83% year-to-date performances of very, very low lows. Let's exclude that. But when you look at the Northern Platinum, 56% year-to-date, Impala Platinum over 47% year-to-date, while the likes of Valterra only just yielded 35%. Now, it's not just, it's again off very low. So I think a lot of that, let's call it worry about the overhang on shares, is most probably starting to price into the price. I think there'll be some movement in the market. I think a lot of people now suddenly who previously sat with Impala Platinum or the likes of Northams will now sit and had Anglo in their portfolio, will most probably sit with both these platinum counters and put them in a position to say, well, maybe it's not a bad idea to start moving or switching some of these, let's call it high-yielding stocks to something like a Valterra that stayed behind, for a while. Platinum in general, I still believe that platinum is looking quite attractive. I mean, this will most probably be the third year where the world, and that's naturally if the World Platinum Investment Council is anything to go by. I mean, this will be the third year where the globe is pretty much in a deficit in terms of supply and demand, meaning that there's a hell of a lot of more demand than the actual supply. So, will I be keeping my Valterras if I did not have any other platinum stocks? Yeah, most probably. I do think that there's some opportunity there. Will I be looking to take this opportunity to maybe switch? That is something that I'll definitely be looking at as well.
Yeah, and I take a point. I mean, there is that deficit, which at some point has to see PGM prices moving higher. Schalk, let's stay with you. We had Robex results out. I mean, good-looking results. The stock up almost double digits today, and maybe that's also partly that they have investigated the whistleblower complaint, said there was nothing there. So I imagine that's also helped a bit. We've got a very small construction sector. Robex, certainly one of the good-looking ones. Your take on the Robex results?
I thought it looked pretty good. Not a company, so I can actually just start off doing the T's and C's. Don't hold any. Really love the little company. I mean, when I said little, I mean they've been active. Growing the headline EPS close to 26%. Again, we know that this you just mentioned the construction sector in South Africa really being small these days. I think Wilson Bailey Homes and very, very small sector. But I thought the results looked pretty good. Yes, you mentioned it. They have these allegations against them. They have the board looked into them, and they came out today and saying that, well, that's it. They couldn't find anything unlawful, brought out the results. And like I said, with a great set of results and this, let's call it not guilty verdict, the share price at one stage up, over 10% this morning. So yeah, I thought it looked good. In general, the construction, let's call it sector in South Africa is becoming a bit of a area where I'll be focusing. Yes, it's small and it's be definitely difficult to sort of overly commit yourself in that environment. But I'm going to talk about, let's call it the property in general. A little bit later. But the one thing that I do love following is the Stats SA data that they produce on a monthly basis, where they look at different types of properties, residential, non-residential properties. The ones that I actually do look at is firstly the non-residential properties that's got plans approved, and then the actual properties that's been completed. And I'll chat about the complete a little bit later. But the one that now started to look interesting is the actual new plans that's been produced to some of these municipalities, a definite uptick, and that could be interesting for these construction companies. Now, remember, if the plans has been handed in, they will most probably start the construction soon. That would be good for our local construction companies.
Yeah, and it's a small sector these days.
Exactly.
Alex, Robex?
Yes, I concur with Schalk. I think the results were very, very good. I mean, all divisions did well, except the materials handling business, predominantly Baobab, which due to lower chrome prices, right? But they are guiding for better chrome prices going forward. So if you look at the situation, order book about up 10%, valuations about P of 7.4 times, and I think it's very likely earnings can probably be double digits over the next year or two. Looking quite interesting, I would say, specifically with this overhang that they had now about the whistleblower also ways. So very good set of results. Part of my point earlier when I said about the GNU and so forth, everyone was anticipating, of course, some structural reforms.
Yeah.
Some expected it to happen this year, but even though it's happening, we're not going to see the benefits of it. But as these things happen with Transnet, Eskom, and general construction, it's going to lift economic activity. And obviously, a business like Robex and Wilson Wade will benefit from that. Even though they're seeing benefits now, most likely will benefit in 2027, 2028. So, yes, I think if you do own exposure and you want to buy in the SA recovery theme, this is an interesting one to consider.
Alex, Dis-Chem results came out Friday. Market, I thought maybe a little aggressive on them. Maybe it's the comparison with clicks. What was your take on those Dis-Chem results?
I think it was a good set of results for Dis-Chem. Obviously, I think the trading statement was a little bit misleading as it didn't disclose some of the ones-off costs specifically to do with the leases that had an impact on H2 numbers. Because they got about 20%, and the actual number came out, I think, 12%. So I think that was a little bit of a reason for the knee-jerk reaction of all small sell-off. But excluding that, I think the business is still looking well positioned. I mean, they'll continue to gain decent revenue growth, margin holding up, and it's very likely you're going to continue to double-digit earnings growth, over the medium term. And the market's willing to pay up for it. The same with clicks. So you are paying a premium multiple for this business. There's a couple of other things to consider also at Dis-Chem. They have brought in quite a lot of new initiatives over the last, call it 24 to 36 months. Some of that might work, some might not. Well, time will tell. They are obviously trying to get better volumes through the wholesale business. For example, supplying to independents and some of their own brands that got TLC. And so there's a lot of moving parts. I think it's reasonably well positioned. The valuation for me, not particularly compelling, and I think you can pretty much look at the share price since it got listed. I think it's only up about 55%. It's pretty much at the same price today as it was December 2017, and that's despite showing very good growth over that period. It's just that valuation has never been particularly compelling. And if you buy something which is too high, the returns won't be great. So for me, I probably would prefer a slightly better entry point. But I can see quite a structural growth story for at least the medium term in Dis-Chem.
Yeah, they did talk around, in fact, accelerating their rollout. Now they've sort of smoothed that out. Schalk, the Dis-Chem numbers for you, it is kind of, I mean, it's the same with clicks. I mean, they're always expensive. You've got to pick your entry on these. What's your take on Dis-Chem?
The one that got away, clicks. so yeah, I'm just going to concur with Alex. I totally agree. I think the trading statement definitely looking better than the actual results. Once-offs definitely, if you strip that out, not a lot of growth. And I think apples with apples. I mean, Dis-Chem currently sitting with just shy of 300 to 285 stores. Your clicks are sitting with 950 stores. When you look at both the results and trading statements, next year, Dis-Chem planning to open another 39. And the likes of clicks are aiming for another 45 to 55. So therein sort of lie your conundrum, choosing between the two. Because as Alex alluded, I mean, multiples paid that you're paying for both these companies, but I mean even Dis-Chem's trading at a cheaper multiple. We're still looking at a company that's trading around about a 23, 24 times forward multiple, whereas new clicks are sitting way over 30, and that's what I'm saying. That's the one that got away for me. I just never been able. It's like Capitec. It's always been expensive, and every year I sort of kick myself and saying, why didn't I just bite the bullet and go and buy that quality stock? Then last thing, great quality company. So yeah, looking at both these companies, not owning either one of them, but most probably the quality within clicks, them being more aggressive, opening new stores, would most probably still keep me in clicks if I had them, not really pulling me to make the switch towards Dis-Chem.
Yeah, so you kicked that door open, Schalk. Capitec. Question coming through. Best local bank. Surely it is Capitec, but it is very expensive. Capitec has been expensive probably since 2010.
You want to make my Monday blue, right, Simon? Yeah, I said the one that got away, but clearly there's two. Yeah, it always remains expensive, but man, what a wonderful, unbelievable South African growth story. I mean, we're not going to look at the growth success yet because we've looked at that many times. Really expensive. I mean, your likes of Absa's, Nedbanks, they're trading just over 1 times book value. Your Standard Banks usually run about the 1.5 price to book levels, and your First Rand always a little bit more at a premium, two times book value. And when you look at a Capitec, they trading at a 6 to 7 times book value. So clearly a premium, but they've always been trading at this premium. I couldn't help but seeing it. We've seen how they've grown from a micro lending bank to becoming really, I would say, not just one of the best in South Africa, but one of the best retail banks in the world. Models that's now trying to be replicated, and now, I mean, there's this thing, the Daily Investor, what do they call it, the banking report, or investor in banking report. They actually came out with that results. FNB is still taking the, let's call it, the preferred personal banking. I think it was more than a third, close to 40% of them choose FNB. Capitec sat with 5% last year, jumping up to 11% of business people now choosing Capitec as their preferred business bank. To show you they're actually constantly growing their footprint in South Africa, now also growing their footprint globally.
Yeah, it has been an amazing story. Schalk, Capitec, I mean, it is expensive. Do we bite the bullet, or do you look at one of the others which are markedly cheaper, but perhaps with less growth?
Okay, so I've got some of the others, and they've been doing well. I mean, we've seen some of these banking stocks doing pretty solidly, lately. Would I look for an entry into Capitec? Yes. I think it's a little bit rich for my liking currently. It's always been rich for my liking, but I think if there's any bit of retracement, we know markets are nervous in general. That will definitely be a company that will be massively on my radar.
Alex, for you, is it Capitec or is it the others, which are, I mean, they really are. And to be clear, I mean, they've got what, high single-digit PEs in many cases, high single-digit dividend yields as well.
I think the change, the transformation that Capitec has done over the last 10 years has certainly caught me a little bit by surprise. So if you think about 10 years ago, the business was purely lending and transactional.
Yeah.
Today, those two components are about 45% of the business. So that diversified quite substantially into insurance, corporate, of course, new initiatives and so forth. So that has really given them another enormous growth aspect, has de-risked the business as well to some extent. And it's just enhanced the overall quality of Capitec. So Capitec is really a great business. And even though I've got my reservations about the valuation, it does seem like if you're going to buy it today and hold it for a few years, you probably will make money. So if you do like it, probably buy it and in the little positions. And if there's a pullback, you can ramp up instead of buying everything simultaneously. But you are paying top dollar. I think that's just something to be cognizant of. If there is a risk of environment in South Africa, you would think Capitec will probably have material downside.
Yeah.
Now, the rest of South Africa banks are quite cheap. Like Absa pretty much gives you almost 10% dividend yield with some earnings growth. So shorter term is probably better to buy something like an Absa. But certainly I will not be looking to hold an Absa over the long term. Capitec's the type of stock, if you kind of 10 plus year horizon, you probably want to rather buy that one. So yeah, that's my thoughts on the banks.
Yeah, agreed. And the Capitec, I mean, it was what, 2,500 on just after Liberation Day, and then, now it's 3,500. Alex, Telkom, another strong update from them. The stock's almost doubled in the last 12 months or so. Is there still opportunity in Telkom?
I would think so, yes. So obviously they've done the SwiftNet deal as well, which restored the balance sheet substantially. Give them much needed capital to invest in the business, specifically obviously in the salary side. So I think they are well positioned. This is a business which has, historically always struggled with balance sheet, but they are starting to overcome some of these hurdles. And I think the valuations are still relatively compelling. We'll have to wait for the dealer results to get an exact sense and what the sense of the growth is from there onwards. But I think Telkom is looking the best it's done for many, many years.
Yeah, it certainly has. I mean, for a long time, it went absolutely nowhere. We've got to go to stock picks. So, Schalk, I'm going to go straight to your pick, Growthpoint.
Yeah, I'm going to be boring this week. And I'm going to be thematical. I mean, because we had the Saab, I don't want to say surprise us, but I mean, I think if we sat here a month ago and sort of discuss interest rate forecast for South Africa, we'd have most probably said we'll see the Saab wait for the Fed to react before they actually start reducing further. They did the 0.25% last week, so yeah, I think one of the sectors definitely would see, have benefit out of this is the local property sector, especially now with some of the economists coming out and say, well, this most probably won't be the last drop. So I'm just going to quickly run again, stating the data that I mentioned to early, the Stats SA buildings that actually been completed. Now I'm talking only non-residential, your shopping centres, non-residential. When you look at that stats, and I actually looked at it over the past 25 years, and I broke it up in square meters per year, so 2000, 2021, 2020. When you look at that data, we've seen massive spikes there. Let's call it 2007, 2008. Remember that property boom. Let's exclude that. Mid 2010s to 2020s, we've been able to still complete anything between 2.5 to 3 million square meters of new non-residential properties per annum. Last year was the lowest amount of properties that can be completed. 1.5 million square meters only be completed. That's the lowest levels we've seen in more than 25 years. Where am I getting to? I mean, we're sitting with a company, Growthpoint. We know that still, let's call it 0.5%, half of them actually made up of the income in South Africa. They've got very, very low vacancies in South Africa. It's less than 8% currently. The total vacancies is 8%. And with the stock getting less and less, remember, if they're not building new non-residential properties, sooner or later people are going to have a high demand for the properties currently in existence. And I do think that looking at a rolling yield of about 9% currently, with the interest rate that actually just dropped down, a company that's trading at 70% its NAV, 31% discount to its NAV. And again, let's exclude that early 2000s where they actually managed to run way over one 1 times book value. Let's just take an average 1 time book value, which we've been able to do around about the 2015s. I think there's quite a bit of upside, plus a very, very attractive yield in Growthpoint. Just get your entry right, but I do think it's looking quite attractive.
And they own half of the VNA, and as they say, they're not making more VNA.
Yes.
Well, actually they are. They're digging out some of Granger Bay, but I think folks get the point on that. Alex, you're going with Sun International.
Yeah, so Sun International is one of those African companies we alluded to earlier in the show that is just looking incredibly attractive from a valuation perspective, and a little bit of growth can go a long way. So if we look at valuation, you're pretty much paying a dividend, pay a P of about 8, dividend yield of about 10%. We expect decent earnings growth from the business. Then the resorts is doing much better of late, but also Sunbet, which is the online gambling business, is growing at exceptional rates, and we think that's going to continue with margin expansion. And I think something that's misunderstood perhaps at Sun International is the incredible cash generation the business has. So even though it's trading at a P of 8, on a cash basis, it's probably on a like 6 times, if not less. So they could pay massive dividends, repay down debt, do acquisitions, and still give you growth. So for me, I think Sun International is offering you an extraordinary opportunity at the moment here. And of course, if there's tourism increase from specifically India and China coming to our resorts and spending money on casinos, that'll also be a benefit. We know, of course, the visas have changed and so forth. Yeah. So it's a lot of things to look out for. So at the moment, I think there's high margin of safety and one to look at very closely.
And I'd forgotten about those visas. That does potentially change a lot. That's all for Stock Watch today. Thanks to our guest, Schalk, Louw, PSG Old Oak, Alex Duys, Umthombo Wealth. Up next, the close. Stay tuned.